In today's episode, I'm going to teach you how to become a more tax-efficient trader. I spend a lot of time talking about my day trading strategy, how I find strong stocks to trade, where I get in, where I get out, how to manage risk, and how to be a more disciplined trader. But you know what? At the end of the year, you could have two traders who produce the exact same amount of profit, and yet one walks away with substantially more money in their pocket because they have implemented some of the very specific tax planning strategies that I'm going to share with you in today's episode. I have personally implemented these strategies in my own trading and have saved millions of dollars. This is a lot of money. My name is Ross Cameron. I am a full-time trader, and I turned a small account with less than $600 into more than $10 million of verified and independently audited trading profits. Now, if you make $10 million in the United States, you're gonna have federal income tax, you're gonna have state income tax, and how much you keep after all that is said and done? Well, you're gonna lose at least probably 40% if you're being safe, about 40%. That's $4 million. I didn't pay $4 million in tax because of the strategies you're gonna learn today. So let's go ahead and jump into this episode. This is gonna help you become a more tax-efficient trader. And something that I wanna talk about is the concept of being more profitable, which is certainly a goal, versus being more tax efficient. Because ultimately, if you are more tax efficient than the next trader, you're gonna walk away with more profit in your pocket at the end of the year. And that makes you a more profitable trader. And it's not about holding your winners longer. It's not about improving your accuracy. It's not about taking bigger share size. It's about the tax planning. This is an important element that more of us should be talking about, but let's go ahead and dive in right here. So what I really wanna focus on is the trader tax status and mark-to-market accounting. These are two really important concepts that most beginner traders have never heard of. So let's jump on the whiteboard for 1 second and let's start to play out a little bit of a scenario. Let's pretend first year trading, you lost $25,000. That wouldn't be unheard of. Some traders have lost more. In my first year trading, I made money. In my second year trading, I lost money. So in the second year, I was down, I was in the red. And here's the thing. Down 25,000, but let's just say, for the sake of argument, that you have a W-2 job and you do have some profit on that W-2 job. Let's just say you made $75,000 on it. So in a perfect world, you would say, well, then I guess my taxable income this year is $50,000. I'm not happy about it, but it is what it is. Well, the IRS disagrees. You know what the IRS is gonna say? They're gonna say you lost $25,000, but that's a capital gain, it's a capital loss. You are limited to how much you can write off against your ordinary income. What's the limit? $3,000. Uh-oh. So you can only write off $3,000 of that this year. So you write off only $3,000 of it. Now the remaining $22,000 goes into a bucket over here, and you can continue, it carries forward, and you can continue to write off $3,000 a year, $3,000 a year, $3,000 a year until you've used it up. That's gonna take a long time, and unfortunately, it's not really gonna help you much today. So now you're gonna pay income tax on $72,000, even though you actually only made $50,000 because of the loss. And let's just take this a step further. Let's say not only did you lose $25,000, you also, as part of setting up your trading station, you bought a computer, you bought monitors, you bought equipment, you did a course, this and that. Let's just say you spent $5,000. Well, the IRS is gonna basically say, you can't do anything with that, forget it, that's just on you. Well, there's a way around that, and that's the trader tax status and mark-to-market accounting. So the trader tax status is a section of the IRS code, which is incredibly complex, as you know, topic number 429. What it states is that if you are an eligible trader, then you can deduct all necessary and reasonable costs related to producing your trading profits. So now that $5,000 here, well, that's back on the table. You can actually go ahead and deduct that because that was a necessary and reasonable cost. We're gonna talk about this. You're gonna get this deduction a different way. So this one you get through the trader tax status. This one you're gonna get through mark-to-market accounting. All right, so these are the two things that we're gonna do. And they're gonna help you a lot. They're gonna bring your income from what was initially $72,000 all the way down to $45,000 in this scenario here. That's a huge deal. That means more money in your pocket. No, it's not great that you lost money, but it's still good that you got this at least benefit from the loss. Now, we're also gonna look at a scenario of a trader who makes money, and I'll show you sort of similarly how it works. So when you have trader tax status, what basically you're saying to the IRS is that I trade for a living, I'm a full-time trader, And therefore, this should be treated as a small business. And all of the expenses that I incur related to running this small business, I should be able to deduct against my income. And the IRS understands that there are people out here that are full-time traders and that is fair, just like any other small business. So what are the expenses that we incur in order to be traders? Well, I'm looking around here at 6 monitors. I've got a laptop. I've got a desktop computer. I've got an internet service. So right there, you can start, racking it up. So start marking it out. You've got your computer. Let's say it's $1,500. You've got $400 in monitors. Let's say you spent $3,000 on education. Let's say you spend $200 a month on software. That's $2,400 a year. Let's say you spend another $100 a month on internet. That's $1,200. Now maybe you say, well, I use the internet for home too, so maybe you can deduct 20% of that or something like that. So let's say you've got $400 there for internet. So you go through all of this, and let's say you've got $7,500 in expenses. Boom. Now you can offset that against your income. As soon as you adopt and tell the IRS that you have trader status, trader tax status, you can make these deductions. So the only hitch in trader tax status is that in order to be eligible, this is what the IRS says. You have to meet all of the following conditions. This shouldn't be a problem for any of you. Number one, you must seek to profit from the market daily. I seek to profit from the market. Okay, maybe I lost money, but I was seeking to profit. I was doing this with some intention. Done. Your activity must be substantial. What is substantial? I'm trading every day. 3, you must carry on the activity with continuity and regularity. I'm showing up every day. Done. Now they have some additional following facts and circumstances, and they kind of lay these out. In the event that you got audited, they're basically telling you this is what an IRS agent would look at in terms of trying to figure out whether or not you're really eligible for trader tax status. The fact is, if you're trading every single day and you're really making an effort, and I mean, it's hard to quantify effort. You're showing up every single day. Your records are showing that you're actively trading. You're day trading. You're buying and selling. You are going to apply for trader tax status. Now, I will tell you, in case you didn't know, I'm not an accountant. I'm not a CPA. So you should always consult with your CPA to make sure they agree with some of the things that I've learned over the years from my CPA, and just to get that actual legal accounting advice. It's a good idea. All right. So as long as you are an active trader, you're going to be eligible for trader tax status. As soon as you file your return, you will attach all of your deductions under your Schedule D. You've got all your deductions there, and then that's going to offset your total gain, which is great. While you can write off the expenses related to trading, you'll continue to face wash sales, and you will continue to be limited to a $3,000 max capital loss. So we now need to address this one right here. We got the deductions related to the office equipment. That's great. Now we've got to get this, so it's a full $25,000. And this comes through mark-to-market accounting. Now, let's talk about what wash sales are for a second. If you've gotten a 1099 from your broker already, you may have noticed at the bottom of the statement, it'll tell you how much you made in profit. And some of you may have looked at it and been like, wait a second, I didn't make that much money. It's saying I made 200 grand. I only made 150. And then you see it, there's another line that says wash sales disallowed, minus 50,000. So those are losses that you took, real trading losses, but they're disallowed. The IRS will not let you write them off against your income. What in the world is that? A wash sale is when you sell a stock for a loss and then you buy back a substantially similar position within 30 days. If you do that, you cannot write off the initial loss. It increases your cost basis, but you can't write off that initial loss. And this originated from investors that at the end of the year in December would sell their positions that they were holding at a loss so they could write off those losses against income. And then they would buy back that same position in January. So they would basically sell, book the loss, and then buy it right back. And so the IRS said, that's not okay. You're not allowed to do that. And that's why we don't get our 1099s until February, because you got to make sure that an investor hasn't bought back that position within that time frame, which would then create a wash sale. So what ends up happening for a lot of beginner traders is they get their 1099 and they're like, whoa, it shows I made more money than I actually made. And now let's do this scenario. Let's just say for a second that you have, you've got the same $75,000 in W-2 wages. And let's say you have $25,000 in profits, but you had $15,000 in wash sales disallowed. So that's adding more income to your total taxable gain. And of course, if you have not done mark-to-market accounting, then you're stuck. So you're just going to face this additional income. So now you're paying income tax on $115,000, even though you actually only made $100,000. And if you haven't done trader tax status, you're not going to be able to write off any of your expenses related to trading. That's crazy. But that's what happens for a lot of beginner traders, because we start trading, but what we don't know is all of the tax implications. But that's not going to be the case for you because you're watching this episode right now. So if we talk about the solution to this, the solution is in mark-to-market accounting. So the mark-to-market election will exempt you from wash sales. It no longer exists for you. You can trade as much as you want. You don't have to worry about buying back a substantially similar position. You can trade the same stock every day for years and years and years, and you will never have a wash sale once you make mark-to-market election. And additionally, you can write off an unlimited amount of loss against your income. You're no longer limited to $3,000 in capital losses. If you have additional losses that put you in the negative, they can be used as a carry forward loss to offset future taxable income in future tax years. So look, nobody wants to have a big loss, but if you have a big loss, doesn't it at least make sense that you can benefit from it in some way, at least offset your income? And you can, as long as you have mark-to-market election. Since so many beginner traders lose money, to me, it makes a lot of sense that before you start trading, you make the mark-to-market election change in accounting methods. So at least if you lose, you have that benefit. And of course, if you make money, then, well, that's fine too. Wash sales are exempt. That's great. So I don't feel like there's any downside to the mark-to-market election. And there's certainly no downside, as far as I can tell, to the trader tax status election. Now, here's one downside. So trading profits are going to be classified as ordinary income. So if you have long-term holdings in the same account that you're day trading in, and you sell them, you're not going to get the lower capital gains tax. You're going to pay the higher ordinary income tax. So you have to segregate your investing between short-term in one account and long-term in another, because otherwise it'll all be grouped together as ordinary income. So the way to apply for mark-to-market accounting is to file Form 3115, notifying the IRS of your change in accounting method. It's under Section 475F. And you have to make the filing by April 15th. So, or the tax due date. Sometimes it's just a couple days before or after, depending on weekends. But you have to make the filing, so file 3115 by April 15th with your tax return. It has to be filed. That was the deadline. You could file it sooner, but it has to be filed by April 15th. And as soon as you file it, you file, and then you have to notify your broker immediately that you have done a change in accounting method, and they'll change your info on their tax report to reflect that you will no longer be subject to wash sales. And then you're done, and that's it. And you don't have to worry about it anymore. So now you've got that same trader back over here who, let's go back to this example of making $25,000 and had $15,000 in wash sales. Those wash sales are gone. So that helps you there. And the minus $5,000 you spent on equipment, boom, that offsets you there too. For the trader who lost money, was down $25,000 plus $5,000 in losses, they now have brought their income down from $72,000 to $45,000. They at least get the benefit. Now, is it exactly what you want? No, you don't want to be a losing trader. You don't want to be losing money, but you want to at least, if nothing else, get the benefit for it. So you've just got to make sure you get this in by the deadline. And if you don't get it in by the April 15th deadline, then you've got to be thinking about wash sales for that entire year. And you could file late, but it won't take effect until the next tax year. So you want to make sure, best case scenario is you do it sometime in Q4, October, November, December. You do the filing, you notify your broker, and then by January 1st of the next year, you've got your broker set up with a new accounting method, mark-to-market, no wash sales. And then when you file your taxes in April, you notify the IRS that you've made a change. And then for that current tax year, you're good. You're all set. So that's kind of like the two most important things. Making sure you're taking advantage of all of your deductions with your trader tax status. That means being organized, keeping track of all the receipts, knowing what you're spending your money on. If you've got your an office space, you've got a home office deduction, there's things you could do there. You just got to make sure you're organized about it. And then with a mark-to-market accounting, that's pretty easy. Once you notify your broker, it's done. It's done. You'll never have wash sales again. And if you have losses, then if you unfortunately have that big loss, you can write off an unlimited amount of it against income from that year or from future years. Now, if you're interested in learning about how to set up your trading as a business, that kind of takes it to the next level. Setting up an LLC or setting up an S Corp. I can walk you through how to do that, and I can also share with you 2 strategies that the top 1% of traders are using to actually pay 0 capital gains taxes on their profits. So I'll put those 2 episodes here for learning how to trade an LLC and learning how to pay 0 income tax on your profits, and it is legal. This is pretty crazy. So make sure you guys check out those episodes. And I want to thank you as always for tuning in, and I'll remind you to make sure you consult a CPA before you make any changes to your taxes.